Mark, what are some specific programs you offer to an investor owner looking to purchase an initial investment property?
There's lots of different options available to people, but one of the things I like to kind of start the conversation with is for people to understand that sometimes people are nervous that they can't qualify for an investment property loan. And what I would argue with that is that it's actually easier to qualify for an investment property loan than it is if you were buying a primary residence. There's more lenient guidelines. The regulatory environment for investors is far less restrictive than it is when you're buying a primary home. So you can document income in more creative ways. There's some loans based on cash flow. So there's lots of different ways that people can get financing that if they were buying a primary home, they might not be able to qualify in the same more laxed ways. That's one of the nice and kind of misunderstood things about investment properties. The other thing is that typically when you buy an investment property, you're buying it with the intention of renting at least one unit, if not more than one. And the rental income that you get from those properties is usable to help you qualify for the loan that you're getting. So if you're buying a cash flowing asset that has really, strong cash flow, and you already own a home, you may not need additional personal income at all to qualify for that loan for the investment property. So there's lots of different solutions. There's more conventional, what we would call underwriting, which is where the loan approval is more based on your personal financials, your tax returns, your pay stubs, if you're on salary or if you're self-employed, maybe a business tax return, where this is called what I refer to as the center lane of underwriting, where it's just plain vanilla standard. You have all the programs available to you with those types of financing, but where a lot of times investors, especially people who are really active in investing, if investing is the primary thing that they do for a living, oftentimes tax returns aren't going to look that good because the tax code is very friendly to investors. And so usually what that means is that you need non-traditional financing, and this could apply to purchases or other types of loan solutions as well. But I'll give one example. There's something for anybody who's not familiar with this called a DSCR loan. So DSCR stands for debt service coverage ratio, which basically means that the loan is underwritten primarily just based on the income that you're going to get from that rental. Even if there's no existing income, it can be off of a market rent on the appraisal report relative to how much it will cost you for your mortgage, your taxes, and insurance. Ideally, you want to be at least even on those numbers, but there are programs that will allow you to even be cash flow negative and still get approval for that loan. So if your tax returns or your pay stub doesn't show enough income to carry another mortgage, that loan could be a perfect solution. It's very popular with our investor clients. I've done some for myself when I'm trying to buy more properties. So there's some really creative solutions to be able to help people acquire those properties. The other thing I would say is that sometimes you can pull equity from one property in order to buy another. So if you already own a property with equity in it, that's a common strategy that people use, or you might pull out, let's say, a line of credit or a cash out refinance from one property to fund the down payment so that you can build your portfolio and tack on another property into your portfolio mix. So lots of different solutions.
Excellent. One of the key takeaways, I think, for everybody on the call from that was the ability to use the rental income in order to qualify for that. So I think that was a key point that came out of what Mark was saying there.